Today we're diving into a question a person close to me asked and many homeowners worry about. What happens if the value of my home drops? Hi, my name is Adrian Ornelas. I'm a real estate agent here in the Las Vegas market. I've been helping people buy and sell homes for 20 years now. Whether we're talking about a small 5% dip or a major 30% crash, let's break down exactly what this means for you as a homeowner. First, the good news, your mortgage payment stays the same. If your home value drops, your monthly mortgage payment doesn't change at all. Your loan terms were locked in when you signed your mortgage agreement. The interest rate, the loan amount, the payment schedule remains exactly the same regardless of the fluctuations of the market. This is actually one of the benefits of homeownership. Your housing costs remain predictable even when the market is volatile. And what about my loan balance? Your loan balance also remains unchanged when home values drop. For example, if you borrowed $300,000, you still owe $300,000 minus whatever principal you've paid down, even if your home is now worth less. One of the biggest fears or myths out there is that the bank may force you to pay off your loan early if the value of your home changes. So will the bank force me to pay off my loan early? This is a common fear, but the answer is generally no. As long as you keep making your regular monthly payments, the bank cannot call your loan or force you to pay it off early just because property values have declined. Same way as if the bank can't force you to pay it off early if your value of the home has gone up. Standard residential mortgages don't have provisions that allow lenders to demand a full payment when collateral value drops. The only requirement is that you continue making the agreed upon payments every single month. The real issue, negative equity or being underwater. The main problem with falling home values is negative equity. When you owe more on your mortgage than your home is worth, this becomes an issue primarily when you need to sell or refinance. For example, if your home drops 20% in value and you had less than 20% equity to begin with, you might find yourself underwater on your loan. This means if you sold your home, you wouldn't make enough to pay off your mortgage. So this is a situation that most people do not want to be in and we all fear. But the reality is that within the first 3 years of you buying your home, you can't expect to be with a profit or even breaking even because it really doesn't work that way. In certain markets, you might be on the positive side of that, but ultimately you're looking to break even from that transaction if you're going to be selling within the first 2 or 3 years of you buying that property. What are my options if my home value drops significantly? Number one, stay put and keep paying. If you can't afford your payments and don't need to move, simply continue making the payments. Eventually, the market will recover and you'll build equity through your regular payments. So if you really don't need to sell, this is not a time to panic if you see the home value going down. Number two, refinance options. If you're underwater, traditionally refinancing is difficult, but government programs sometimes exist to help homeowners refinance even negative equity. So these programs are strictly, for the most part, for FHA borrowers or even VA borrowers, but you could always look into with your servicer or your bank. Number three, short sale. If you must sell while you're underwater, a short sale where the lender agrees to accept less than the full loan amount, this might be an option, but it affects your credit. This happened a lot during the recession of 2008 to 2014. A lot of people had to do short sales, but it was a much better option than to having to foreclose on the house. And short sales have always existed. Banks always know that there's a possibility that that asset that they are underwriting could potentially either be the same value or lose value, but the bank ultimately wants to recover their investment. So sometimes they will approve a short sale depending how big of a gap there is between that loan amount and the value. And so the bank has to benefit because they don't want to do a foreclosure either. And so a short sale is not a great option, but if you don't have any other choices, you definitely want to try to see if this is possible for you if you need to sell right now. Number four, loan modifications. Some lenders may be willing to modify your loan terms if you're struggling. This has been a very common option for some people because since 2020, a loan modification has been a big option that a lot of people have opted for because it allowed them to not have any payments for a certain amount of months that the bank may allow so that people could eventually catch up and continue to keep their home and also their low mortgage interest rate. But here's the bottom line. A drop in home values only really matters when you need to sell or if you need to tap into your home equity. The bottom line, a drop in home values only really matters when you need to sell or tap into your equity. But if the market does have a downturn, if you can continue making your monthly payments and you don't need to move, you can typically ride it out. So just don't panic if the market does take a turn, but also assess your situation and that will tell you what you really have to do, or reach for some advice of somebody that could help you decide what's the better option for you if the market was to change. Remember, real estate is typically a long-term investment, and historically, property values have recovered from downturns given enough time. So don't panic. The market always recovers at some point or another, but is also very circumstantial depending on your situation and the equity that you could have or you have lost. So the market always has fluctuations. And what I always tell my clients is that if you are going to be buying today, just imagine that the home perhaps doesn't go up in value. So if you're planning to buy a home and want to sell within the next 2 years, just don't be surprised if you really don't have that much equity. You can't expect to have a 20% or 30% increase within 2 years because it's just not realistic. So looking at your home as a realistic value, just imagine that your home perhaps doesn't go up in value that much or at all within the next 5 years, and you're actually paying the home down. So at some point, you're able to recover your money, but the probability and what the stats have showed the last 40, 50 years is that your home will most likely go up in value if you stay in your home past 3, 5, 10 years. That's it for today's video. If you found this helpful, please hit the like and subscribe for more real estate and Las Vegas market update. And don't forget, drop your questions below and I'll see you on the next video.